welcome to my fourth lecture on economy. Today we're going to be discussing about money and banking. Okay, so what is money? Money is a widely accepted commodity that can be used to exchange goods and services, pay debts, and measure value. These are the functions of the money, generally speaking, to exchange goods and services, pay debts, and measure value. Apart from this, there are categorization of these functions. I'll tell you this categorization. There are primary categorization, secondary, and contingent. So in primary function, what is the primary function of money? It acts as a measure of value. Like you can measure, like say 5 rupees, 10 rupees. You can measure that value by in that note or a coin or whatever. Okay, then it acts as a medium of exchange. For 10 rupees, you can buy, let's say, 100 grams of rice. Like that, you can. It acts as a medium of exchange. Money acts as a medium of exchange. Then these are the primary functions. Secondary functions: it acts as store of value, transfer of value, and deferred payments. What is store of value? Like you can it is durable, that amount, like whatever you earn, let's say you earn 1000 rupees, you can store that value for how much of a time you want. It won't rot away. Okay. Same applies to white money and black money. Whatever kind of money, it will stay like that only. Then transfer of value. Let's say a soldier is working in Kashmir. He wants to send money to his parents who is living in Kanyakumari, so he can send that money via bank accounts. So that is a secondary function. Then another secondary function is deferred payments. Deferred payment means thode dena, money, like equated monthly installments, EMI. You delay the payment and you give little by little. So that is deferred payments. Then contingent functions. This is based on the primary and secondary functions. Contingent means dependent functions, dependent on primary and secondary. Now, basis of credit systems like shares and bonds, right? That is a contingent function, basis of credit system. Then employing factors of production. If you want to employ land, labor, capital, entrepreneur, if he wants to employ people, he needs money, right? This is also one function of money, employing factors of production. Then creation and distribution of national income via taxation. For taxation purpose also we need money. Okay, this is how the money is divided. It's given in NCERT and it can come in prelims also. What is the primary function, what is the secondary function, contingent function. So you should be able to tell this. How to remember secondary function? You can remember it as STD. Okay, and don't get confused with measure of value and medium of exchange. Don't put them over here. Okay, then now we will go to evolution of money. In earlier times, we see barter system all over the world. What is this barter system? Barter system is nothing but exchange of goods and services, and there is no money involved here. That's all. Exchange of goods and services. But this barter system has two major problems. And there are more problems also, but the two major ones are double coincidence of wants and valuation issue. One second, let me adjust the size. Double coincidence of wants and valuation issue. What is this double coincidence of wants? Let's say A and B are there. A makes wheat and B makes rice. Now they have to sell. So what does A want? A wants to sell wheat, right? And what does B want? He wants to sell rice. Now A has to find this someone who wants to buy this wheat. Here B wants to buy this wheat, and B wants to find someone who wants to buy the rice. So he finds A. Okay, so double wants they have. He wants to buy rice and sell wheat, and this guy also has a double want, buy wheat and sell rice. So double wants are coinciding here. So this is a good thing for this interaction over here, but this is not going to happen always, right? This is very specific demand. It's not going to happen always. A cannot always find B, and B cannot always demand wheat. He may have other preferences as well. So this is a limitation of barter system. You may not always find your buyer or seller, right? Another problem is valuation issue. Like for example, he is going to sell wheat, no, and this guy is going to sell rice. How much quantity of wheat should he sell to get the appropriate amount of rice? We don't know. So this is another problem. Okay, apart from this, there are other problems like rice and wheat. They are perishable, right? They can expire, shelf life they have, and it doesn't promote specialization and division of labor. Suppose a person has money, let's say. Okay, now what he can do, he can tell a person, like for example, this person is X, he has money, he wants to buy wheat, let's say, from A. Now A can tell that I make wheat, I make atta, and I make roti also, and you can give options to this X. You can buy whatever you want to, right? So what is A doing here? He's promoting, he's employing one person to harvest wheat. He's employing one more person to make atta. He's employing one more person to make roti, right? So what he's promoting here? He's promoting division of labor, right? This person A promoting division of labor, and each individual person will be specialized in it. He'll be able to make he'll be able to harvest wheat efficiently. He'll be able to make the finest quality atta, and then people will be able to make the softest roti possible. So it promotes specialization, right? Money promotes all this, and he gets to choose whatever he wants to, right? So it promotes division of labor and specialization. But in case of barter, it is not the case. It doesn't promote this because money is not involved here, goods are involved. Another problem is fungibility issue. Now what is this meaning of fungibility? Fungible means dividable. Okay, let's say 1 kg gold is there. You can divide this into small 10 bars of each bar 100 grams. It will have the same value. 1 kg gold and 100 grams into 10 bars will have the same value. That means it is fungible. Value remains same even if it is divided. Non-fungible means if it is divided, no, the value will not remain same. For example, there's a very big diamond, 1 kg, let's say. Its valuation is 5 crore. But if you cut this diamond into small diamonds, let's say 100 grams into 10 diamonds, it will just be worth of 5 lakh. So this is an example of non-fungibility. Value is not same. It depends on the shape and size and weight and all that. Right. So if you're using goods, no, the goods, for example, you're using this diamond as a stone. You're using this good for exchanging another good. So non-fungibility is a problem here. Like he cannot give small diamonds and ask for the same quantity of good which he wants. He has to give that big diamond only. Now this is all very complicated. No, it will get complicated if barter is used. That's why this one limitation. Yeah, we solve this, no? Then because of these problems, people shifted to a different commodity like money, such as shells. Now shells started coming up after this goods and all that. They started using shells, but later these commodities got replaced with metallic money, gold, silver, copper coins and all. But carrying money was difficult. Ultimately led to paper currency. We'll see one by one how this. What are the limitations of shells? What are the limitations of metallic money? Okay, we'll see that one by one. Then with the digitization, we are witnessing a few forms such as digital currency, cryptocurrency and all that. Okay, now we'll see how this, what is commodity money. Commodity money means, we saw that shells. And another example is cocoa beans, whale tooth. All these were being used as commodity money. Cocoa beans was used by Aztec tribe. Tell me your homework. Aztec tribe is from which country? Okay, then whale tooth, no, let's say if someone gets whale tooth, a particular region gets whale tooth, only in that region it will be famous. But for foreigners, it has no value. If foreigners gets these whale tooth, wants to do any transaction, it has no value to them. So this is the limitations of commodity money. And they are also perishable. Cocoa beans, they are perishable and they are not uniform. They are not pure. These are all the limitations. That's why they had to move to, over the course of time, they had to move to metallic money. Now, metallic money we see in Indo-Greeks and Kushans in history. They issued gold coins first time, right? Then Gupta, they also issued gold coins, spectacular gold coins, which had depictions of kings various musical instruments, boats, and all that. Then Delhi Sultanate, they started issuing silver coins because of the gold shortage and all that. Silver Tanka, it was called, Delhi Sultanate. Then Sher Shah Suri introduced rupiah. This is also gold, silver coin. Akbar introduced more. Yeah, all these are silver coins. These are gold coins. Now these type of coins, no metallic money, this gold and silver, they are known as full-bodied coins. Why? Because the intrinsic value is equal to the face value. Now, what is this term, intrinsic value and face value? I use two words here. Intrinsic value and face value. What is this? Intrinsic value means the metal itself has the value. For example, I can use that metal, right, as money by making some shape, like circular shape or something. I can use it as money, or else I can just melt it and make jewelry out of it, right? So the metal has the value here. It doesn't matter what you write on that. Let's say I write 5 rupees. That doesn't mean that gold coin is worth 5 rupees. That gold coin has more value than that. So it has an intrinsic value. But this gold coin and silver coin had a problem. People could melt it, no? So what they did, they tried to, it led to the shortage of the metal in the economy. For example, we see in history that during the 14th century, Tughlaq tried this experiment. He, since there was a shortage of gold and silver currency, that gold coins at the time, he invented token currency. What is token currency? Token currency means intrinsic value is not equal to the face value. I'll come to that. Okay, I'll just tell you here only. Token currency. What is this? Intrinsic value is not equal to the face value. They are using cheap metals here, and they assign a higher face value to it. What is this face value? Let's say this is a gold coin. I write 5 rupees on that. Okay, but gold coin ka worth is, let's say, 2000 rupees. But this, what is written on it, 5 rupees, is the face value. Okay. So this is the difference between face value and intrinsic value. When intrinsic value is not equal to face value, that is when it is called as token currency. So let's say, for example, this 5 rupee coin is there. Remember that 5 rupee coin, which is a golden yellow color? Yeah, that consists of these following metals: copper, zinc, and nickel. Copper has 75%, zinc has 20%, and nickel has 5%. Now, if you take these individual metals, no, they have lesser than 5 rupees ka value. So, and they are an alloy, right? So even if you melt it, you cannot separate them individually. Right? This is an example of token currency. Intrinsic value is lesser than the face value, that is 5 rupees. Similarly, Tughlaq also, he introduced token currency. Cheap metals. These cheap metals consisted of brass and copper. And he told that these cheap metals are equivalent to silver coins ka value. Okay, so what he did, he used a brass coin or copper coin, and let's say 5 rupees he told, and this is equivalent to 5 rupees silver coin. This is a brass coin. This is what he did. So what did people started to make? People started to make fake currency, counterfeit currency. So this experiment of his failed. They started making fake currency because it was cheaply available. Privately, they started minting their own money. Right. So this is one problem of full-bodied coins if they use it. So another problem is you can melt it and mix it with other metals, right, and make coins. This saves the resources, but it leads to inflation. How? People will start hoarding the good quality coins like gold coins and silver coins. They will start hoarding them, or they might start even hoarding some commodities like grains, spices, and textiles and all that. So this, what will it will cause? It will cause supply to become less, but demand is same. So if this happens, price will increase. So it leads to inflation. And there's another problem of full-bodied coins. Okay, I hope you understood full-bodied coins. So solution is token currency. In token currency, in token currency here, people could separate the constituents of the cheap metals in Tughlaq's case. But what we have done is we made an alloy, right? Alloy cannot be separated. So that's why token currency is better than full-bodied coins. Okay, we even this normal coin, you see that silver coin, not silver coin, but steel coin. That also is an alloy. You cannot separate the constituents. There are like particular percentages which are mandatory to be present in that alloy, and this is determined by the Coinage Act, governed by the Coinage Act. How much you have to mix and all that, and if you're minting privately, you'll be arrested under this act. Okay. Then because of all these limitations, we shifted to paper money. Now paper money it has no intrinsic value. You can see this normal 5 rupee notes, 10 rupee notes. You cannot use that to make notes or something, or make diary or whatever. So it has no intrinsic value. It has only face value. Okay. Now there are two types of money: fiat money and legal tender. We'll see what is fiat money. Fiat money means it has to be in physical or digital form, and it has to be simultaneously. I'm writing this. I'm giving more emphasis on this. And issued by a king, government, or a central bank. Now I'll give you an example. Let's say, is Indian rupees, let's say 5 rupee coin, is it a fiat money? Okay, first let's see the first condition. Is it physical form? Yes, it is in physical form. Is it issued by central bank? Yes. So both the conditions are right. So 5 rupee coin is a fiat money. Now let's say government security. Is that a fiat money? Is it in physical or digital form? No. Government security means it is not in the physical or digital coin, let's say, coin or notes. It is not in that form, government security and treasury bill and all that. So this condition is not satisfied, but it is issued by the central bank or government, like government securities, right? So that is not, since it is not fulfilling this condition, it is not a fiat money. Another example, let's take dollar. Is dollar in the physical form of note or coin or whatever? It is correct. Dollar is in the physical form, and it is issued by central bank of or the government of USA. So that is a fiat money in that country. Okay, that is what is fiat money. These two conditions should be satisfied. Then what is legal tender? Legal tender means it has to be a fiat money. Okay, first condition, and here also it is and. Okay, other party cannot refuse it. He cannot deny from taking it. For example, 5 rupee coin only you take. It is a fiat money. Now if you go to the shopkeeper and ask him for some commodity, the shopkeeper cannot refuse your 5 rupee coin. So it is legally valid in India. So it is a legal tender. Another example, is the dollar a legal tender? See, dollar is a fiat money, but if you give dollar to the shopkeeper in India, he can refuse it, right? So it is not a legal tender. Now let's say demonetized 500 rupee note. Is that a fiat money? Yes, it is a fiat money because it is in the physical form and it is issued by the central bank, right? So it is a fiat money. But is it a legal tender? No, because fiat money condition is being satisfied, but other party can refuse it this time because it is withdrawn from circulation. It is just demonetized. So it is not a legal tender. Okay, I hope this is clear. Now in legal tender, there are two types: limited legal tender and unlimited legal tender. Limited legal tender it includes coins. Now let's say you go to a shop, you want to buy an iPhone. You cannot go to the shop with one rupee coin. Okay, let's say the iPhone costs 1 lakh. You cannot give a 1 lakh in one rupee coins. Shopkeeper can refuse from taking it. There is a limit on how much coins you can give. That limit is governed by the Coinage Act. Okay, according to that act, no, you can give one rupee coin up to 1,000 rupees. That's all. After that, the shopkeeper can refuse you. Similarly, for 50 paise also, only 20 coins you can give maximum. You can't give more than that. That is 10 rupees it will be. These are all governed by Coinage Act. I think for each currency there is a limit, specific limit. No need to go into the details. I'm just telling you what is the meaning of limited legal tender. And unlimited legal tender, it is nothing but your normal currency notes. Like 200 rupees, 100 rupees. You can give any amount of currency notes. The shopkeeper won't refuse it. However, in real life, according to Finance Act of 2017, cash transaction of up to 2 lakh only you can do using cash. Up to 2 lakh. After 2 lakh, you have to use any check or NEFT or demand draft or something like that. Okay. So, but other party can take money in black, so it is an unlimited legal tender. You know what is a black money? Black money means which is not taxed. Okay. Whatever money you're going to pay within this 2 lakh limit, all this will be taxed. After this, you're going to pay in check, no? This also will be taxed. But if you're going to pay in cash, only cash, then no tax, because there is no traceability of this cash. Right. Then, now there are different types of currencies in India, like 1 rupee or 1 rupee note. There are so many coins, there are so many notes. So who makes all this? Two people will make this, one RBI and one government. RBI will make, we'll see government first. Under the Coinage Act, no? Government will make coins from 1 rupee till 1,000 rupees. Coins they will make. They are eligible to make these coins according to Coinage Act. And this 1 rupee note is there, no? This also is made by Government of India. 1 rupee, I'm talking, this is coins, this is note. It is this note, no? It is signed by the Finance Secretary. Okay, and this is only for Government of India. For remaining all of the notes and not coins, only remaining all of the currency notes, other than this 1 rupee note, RBI will issue the notes under the RBI Act of 1934, and the RBI governor will sign on that note. You will see in that note, it will be written, "I promise to pay the bearer the sum of amount 2,000 rupees or 1,000 rupees," like that. What is the meaning of this? I promise to pay the bearer. It means if the note, let's say, gets damaged, torn or something, you can go to the Reserve Bank of India and ask them for a replacement of that, and they will give you the replacement. They have to give you that replacement. That is the meaning of this, I promise to pay the bearer. Whereas in this one, no, in 1 rupee note, this I promise to pay the bearer is not written. Okay, this is just one fact which is like, you should just have to know this, that's all. No explanation to this. Okay, this, this diagram, no? It's called a Venn diagram. Okay, whatever is this circle, it is in the ambit of the Government of India circle, and whatever is outside the circle is under the ambit of RBI. Okay, what is inside the circle? 1,000 rupee, from 1 rupee coin to 1,000 rupee coin, and 1 rupee ka note, that falls under the ambit of Government of India. Remaining all falls under the ambit of RBI. Okay. Next, now there are some limitations to this paper money. What is the limitations? You need to print that money, right? It will take you ink, it will take you paper, it will take machines. So all this will cost a lot of money. So this is the one limitation. So what did people do? People started making inventing checks and demand drafts. Okay, what is this check? Check means there will be a paper. Okay, you just have to write your amount on that and sign it and give it to the bank, and they will give that. No, sorry, don't give it to the bank. Give it to the person. That person will take it to the bank, and that bank will deduct from your account. So that's how the check works. How does the demand draft work? Let's say a person is there, right? He wants to take admission in Vajiram, so he deposits the required amount in the bank, right? And the bank will give him DD, demand draft. That demand draft he will go give it to Vajiram. What will Vajiram do? He'll take that demand draft and go to the bank and retrieve the money. This is how demand draft works. Person is already depositing the money here beforehand only. Okay. Now there's one problem in check. What is this problem? Let's say I give you a check, right? I write 1,000 rupees on the check. Okay. I give it to you. You have the, let's say you change from 1,000 rupees to, you add one more zero here. Okay, and then you go to the bank. Now bank, how will it verify that this is the correct amount which I have given to you? So this is one problem. So what did the bank, what did RBI tell the make the guidelines? They invented positive pay mechanism. For example, this is me, this is you. I want to send money to you. Okay, I have SBI account, you have Axis Bank account. Now what I will do is, I will take a check. Okay, I will write the required money, let's say 1,000 rupees. Okay, and I'll sign it, and I will take a photo of this and upload it in my SBI portal. Okay, then I'll give you this check to you. Then you will take this check and give it to Axis Bank. Axis Bank will scan it. Okay, then it will match with the photo which I had sent, which I had uploaded in the SBI portal. They will match this. If it is correct, it is matching, then only they'll give you money. This is how positive pay mechanism works. Okay, this is one in recent initiative what they took. Okay, then okay, I think we finished all this. Okay, one more thing. After this bank money, what came? Electronic or digital money, like CBDC, crypto, right? We see all this. Okay, then NPCI. Okay, what is NPCI? What is why is this created? To make cost-effective payment solutions for banks. The purpose of creating NPCI is to make cost-effective payment solutions for banks and to provide financial inclusion to the society. Okay. It is a non-for-profit company. So if it is a company, it has to be registered under the Companies Act. Okay. Operating under the Payments and Settlements Systems Act of 2007. It is an initiative of RBI and Indian Bank Association. Like 10 banks came together, right, and they gave 100 crore capital and they made this NPCI. Okay. Now before we go into all these products and all, let me give you how digital transactions happen. Now, digital transactions, no, there are two ways in which digital transactions can happen, either through RBI or through NPCI. Under RBI, there is a specific portal called eKuber. There all these transactions happen, huge amount. RBI is for huge amount of transactions. NPCI is for small amount of transactions. Okay, RBI, what it will do, there are two types of transactions, RTGS and NEFT. What is RTGS? Full form real-time gross settlement. NEFT full form National Electronic Fund Transfer. In RTGS, you can have to send a minimum of 2 lakh rupees. If you want to make a transaction, you have to send minimum 2 lakh rupees, then only you can use RTGS, and up to 2000 crores. So this is a very huge amount, so it will generally be used for business purpose. Whereas in NEFT, up to 10 lakh you can send, not more than 10 lakh. Okay. Now, how does this real-time gross settlement work? Let's say I am here and you're here. Okay, I want to send 5 lakh to you. Okay, so what I will do, I have 5 lakh in my SBI account. So I will give a request to debit 5 lakh from the account and send it to you. So what SBI will do? SBI will debit that amount and will send the request to RBI. Okay, and RBI will accept that request and transfer the amount to your bank account, which is Axis. Yeah, and you will get that amount 5 lakh. Now this happens immediately. Like if I give that request, it happens instantaneously. So you get that money. So that is the benefit of real-time gross settlement. Whereas NEFT, NEFT, same thing is happening, but at an intervals of 30 minutes. Like 30 minutes, once in every 30 minutes, my request will be processed. I have to wait for 30 minutes for my request to be processed. It won't happen instantaneously. So that is the difference between NEFT and RTGS. Okay, and both these facilities, only banks can provide. Okay, whereas then NPCI may they invented this IMPS. What is IMPS? Immediate Payment Service. Like it is valid only for transactions from 1 rupee to 2 lakh. I think this 2 lakh they have increased it to 5 lakh recently. I'm not sure about this amount, but you can verify. Okay, NPCI use IMPS settlement system. This is also instant settlement. There is no 30 minute window or something like that. Okay, NEFT and IMPS, they are used by ordinary people. Okay, here also who can provide this facility? Banks can provide this facility, or PPI means prepaid payment instruments, like for example PhonePe, Paytm, Google Pay, all that. They can provide this IMPS system. Whatever UPI you use, it is based on this IMPS system, settlement system. Okay, now we'll go back. Okay, we finished this NPCI. What are the products? NPCI creates of products. So this is the company, it creates a products. Now what are these products? RuPay. It launched in 2012 and supports the issuance of debit, credit, prepaid cards by banks in India. Now they have used the word debit and credit. What is the difference between debit and credit card? I'll just tell you in brief. Credit card means bank is going to give you some money, okay, as a loan, then you can spend it, and you have to return that money in the form of some interest. Debit card means bank is going to deduct some money from your bank account, which already has some money which you have already deposited. Okay, a loan is taken by customer to make a purchase. In the case of credit card, let's say bank gives me a credit card. Okay, I make a transaction using that credit card. When I make the transaction, who pays money for that? The bank will pay money from their own funds to the merchant. Okay, and after some specified time, I can pay the money back to the bank either through equated monthly installments or at a time, but they will charge interest on me. Credit card can also be used to withdraw money, currency notes, but bank will levy interest on that. It may or may not have insufficient balance. Your credit card may have some balance or may not have some balance. They will give you that money as a loan. Whereas debit card, if the customer wants to purchase or do a transaction with the merchant, here bank will pay the money from the customer's funds, whatever savings account he has, from there they will deduct money and give it to the merchant. If there is insufficient balance, you cannot make a purchase, provided there are some exceptions to this, like overdraft facility. Like you have zero, let's say you have 0 rupees in your bank account, banks can give a facility like overdraft facility where you can make transactions up to certain limit, let's say 10,000 rupees. Up to 10,000 rupees you can use that card, but they will charge some interest, I think, after this, if you're going to use it after zero balance also. That is overdraft facility ka meaning. So this is a difference, broad difference between credit card and debit card. But there is one problem with this credit card and debit card. Like, let's say you go to the shopping website like Amazon. Once you use your credit card or debit card, it will store that information, right? It will store the card details of that card number, CVV number, and all that. So it is prone to hacking. So what innovation they did? They encrypted this number, or this bank account number and all that, into something called as a token number. This process is known as tokenization. It is used for online transactions. This token number is used for online transactions. If you do one more transaction next time, this token number will be used. Okay, not your actual bank details. Its encrypted version will be used. This is how they overcome this. I'm telling you all this because in prelims they can come, what is this tokenization? Right? They can ask you credit card, debit card details. They can ask you RTGS, NEFT, NPCI, IMPS. They can ask you this limits also, but it's not that important. Okay, overall, I think you understood. Then products. Okay, products of NPCI. NPCI invented RuPay. What is RuPay? It is a payment gateway like Visa, MasterCard, but has less service charge. It is an Indian payment gateway. Visa, MasterCard and all, it is US payment gateway. So this is for within Indian transaction, right? Similarly, if you want to do cross-border transactions, then the payment gateway is Western Union, MoneyGram, like that. So NPCI invented this RuPay. Then IMPS, I already told you about this real-time fund transfer, which is instant, 24/7, and interbank electronic fund transfer happens here. Yeah. Then BHIM, Bharat Interface for Money. It is a mobile payment application based on UPI. It is an app. BHIM is an app which uses UPI. What is UPI? UPI is a technology to build payment apps based on IMPS. We saw here no IMPS. NPCI kind product. It is a real-time payment system that facilitates instant money transfer between bank accounts via smartphones, and UPI enables users to send and receive money, pay bills, make online purchases seamlessly through a single app. Self-explanatory. UPI eliminates the need to enter detailed bank information for each transaction, simplifying payments through QR codes. Virtual payment address. Virtual payment address means you'll write that at like your name at OKSBI. So these are all virtual payment addresses. Your UPI registered mobile numbers, all these are being used for UPI transactions. UPI works by leveraging existing systems such as IMPS and AEPS. Now, what is this AEPS? Aadhaar enabled payment system. Here, no, it is AEPS also is a product of NPCI that allows bank customer to use Aadhaar as an identity to access his Aadhaar enabled bank account. And for what? For performing basic transactions like balance inquiry, cash withdrawal, remittances through business correspondent or something like that. Now, what is this Aadhaar enabled bank account? Example is Jan Dhan account. In Jan Dhan account, no, it is used, government gives direct benefit transfer into this Jan Dhan account. For example, Manrega wages, LPG subsidy, all this is put into the Jan Dhan account, which is Aadhaar enabled. Take another example is Bank Mitra. They have Bank Mitra means a person will be employed by the bank to go to rural villages. Okay, and that person will have some money in his pocket, and he'll also have some small machine, POS machine, POS point of sale machine. So he will go to that village and he will ask the people to create a bank account or ask people whether they want to deposit money, they want some money as a loan or something like that. So people will give that money and he will write that down and he'll give from his pocket. Right? He's acting as a bank here, that person. So he's known as Bank Mitra. And for that purpose also, how he will verify? He will verify using Aadhaar. So he is acting like a micro ATM here. Okay. Then other products also NPCI made, like the common mobility card, for example, Metro card. That is a common mobility card. Then Bharat QR code. Like for example, before Paytm had a separate QR code, Google Pay had a separate QR code, MobiKwik and all, they had separate QR codes. So this got eliminated. RBI told you have only one type of QR code for all the payment apps. So they invented Bharat QR. Same QR code for all the payment apps. Okay, then Bharat Bill Payment System. This is also one product of NPCI. What is this Bharat Bill Payment System? For example, you want to pay gas bill or electricity bill. It will automatically deduct from your account the required amount, what is mentioned in the bill, every month automatically. So this automatic deduction is facilitated by Bharat Bill Payment System. Then NACH. NACH is National Automated Clearing House. It's for bulk payments. Let's say every month they have to pay salary. Companies have to pay salary to their employees. Insurance companies have to pay insurance premiums, or you have to pay insurance premiums every month to the insurance company. Then pension, dividends, companies have to give dividends. This happens on a monthly basis for bulk, in the bulk amount. This is facilitated by NACH, National Automated Clearing House. It's also issued by NPCI. Okay, these are all the products of NPCI. After that came central bank digital currency. Once again, before we discuss this, I want to discuss this merchant discount rate. What is merchant discount rate? Let's say I have a card, right? I want to use this card to buy a fridge. Now card has these details: account number, sorry, not account number, card number, and my name, and behind this CVV will be there, 3-digit CVV. Okay, and this is the payment gateway. Visa is the payment gateway. This is the card name. Okay, now what I will do, I'll swipe the card on the machine. What is that machine called? POS machine, point of sale machine. This machine will be there with the merchant, and merchant means the shopkeeper. And this machine will be given by the bank to the merchant. Let's say Axis Bank gave this to the merchant. So once I swipe that card to buy the fridge, 3 people are going to deduct money from this poor merchant. Who are those 3 people? First of all, this SBI card, SBI bank account which I have, they will charge some commission. Okay, then Visa, they are providing payment gateway. Okay, so they will also deduct some amount. And Axis Bank, which is providing this machine, so they will also deduct some amount. They are called as MDR fees. Together they will be called as MDR fees. This MDR fees has to be paid by the merchant. Okay, merchant has to pay this. So it discourages the merchant from using POS machine. So what did the government do? Government said we'll give subsidy for this. They started paying for this MDR fees. Okay, so at one point of time it was absolutely free. So it encouraged merchants to use point of sale machines. But now I think there is some minimum amount which, since digital penetration and all has increased a lot, so I think there is some minimum amount of fees which has to be levied on the merchants now. Okay, this is merchant discount rate. Okay, this is a concept which might be asked in test series and not given in this blue book. Okay, now we'll go back. What is a central bank digital currency? It's a form of digital currency issued by country's central bank. Same like normal currency only, but it is in the digital form. Okay, their value is fixed by the central bank and is equivalent to country's fiat currency. Now see, fiat currency. Why is this fiat currency? Because it is, what were the 2 conditions? It has to be in physical or digital form. Now it is in the digital form, right? It is in the form of a coin and currency, yes, but it is in the form of digital coin currency, and it has to be issued by government. It is issued by government here, so it is a fiat currency. But okay, is it a legal tender? Yes, it is a legal tender. other person cannot refuse to accept it. So it is a legal tender. Then using CBDC, countries will be able to directly exchange digital currencies in a bilateral way without going through SWIFT. What is a SWIFT? SWIFT is like a settlement system, okay, for cross-border transactions. It will monitor the cross-border transactions. So you don't have to go through this. You can just use directly CBDC and overcome all this SWIFT and all that. Okay, but CBDC cannot entirely replace normal currency. It just supplements the physical currency. Why? Because there are some limitations to this CBDC. What are the limitations? There is digital divide, right? People don't know how to use digital technologies. Then they don't know how to operate these bank accounts digitally, UPI and all that. They don't know how to use. Then internet connectivity, that is also a problem. It is not penetrated throughout India. Then they are prone to cyber attack. Since it is all digital, it is prone to cyber attack or even natural calamities or man-made disasters. So all this it is prone. That's why you should not rely solely on CBDC. You should use physical currency as well. This only acts as a supplement. Now, what are the benefits of CBDC? This will reduce the printing costs. Right? Till now we are printing so much money that was very expensive. So it will reduce it. And it will also reduce counterfeit currency because this is issued by the central bank, right? So there is no chance of modifications to it, right? Then it will also increase traceability, where this digital rupee is going from which hand to which hand. That and all can be monitored in this. It will reduce anonymity, right? Then it can be programmed. This digital currency can be programmed so that it can be used for a specific purpose. Let's say they make a coin, digital coin. This coin can be used only for student loan. Like the banks can give this digital currency for student loan purpose only, nothing else. It will be invalid if it tries to do another purchase with this money. So they can program it. Another advantage, this would be the last advantage, is if you're using normal currency, it will be prone to spreading virus and all that, communicable diseases like COVID and all. We saw, no, we stopped using notes. So digital currency can reduce that. Okay, CBDC is over. After CBDC, cryptocurrency will come. Cryptocurrency, what is it? Why was it invented in the first place? Some people had lost faith in the fiat money because of that subprime crisis which happened in 2007. What is a subprime crisis? In USA, they started giving money, or they start giving money to everyone as a loan. So this led to a default kind of situation. Like people were not able to repay the loan back with interest and all that. So it's led to a subprime crisis. So it eroded the purchasing power of dollar. What is the meaning of this purchasing power? Let's say today, $1 you can buy one bread loaf. After this erosion of the purchasing power, okay, which means, let's say the same amount of bread loaf you can buy now for $2. It has become expensive. So that means for $1 you can buy half of the bread loaf. So purchasing power has decreased. It eroded the purchasing power of dollar because inflation happened. So now $1 to $2 became. Because of inflation, it erodes the purchasing power of dollar. So this is why people lost faith in the fiat money, and also they disliked the bank money because for doing transactions there was transaction charges, and there was MDR fees for the merchant, and there was interoperability issues like that QR code. There was separate for Paytm, separate QR code, for Google Pay, separate QR code. All these issues people didn't like. This way, one person is there called Satoshi Nakamoto. He invented a cryptocurrency called Bitcoin. Okay, what is a cryptocurrency? First of all, it is a digital or virtual currency that uses cryptography for security. Cryptocurrency means some encryption. It is a decentralized currency, meaning it is not controlled by any government or institutions. Decentralized means it uses blockchain. ठीक है. Some examples of cryptocurrencies: Bitcoin, Ethereum, Litecoin. Bitcoin में like there are only 21 million bitcoins in the world right now, and one bitcoin is worth 10 to the power 8 satoshi. So this is the smallest value, 10 to the power 8 satoshi, and it is not a legal tender in India. Why? Because is it a fiat money? No, it is not a fiat money because it is not issued by the government of India or any king or central bank or what. So since it is not a fiat money, it is not a legal tender. Okay. Now, how is this cryptocurrency obtained? It is obtained through mining. What is this mining? Like they use powerful computers to mine the blockchains. After this, they get some very little amount, let's say 0.5 bitcoins or something like that. So this is how they obtain cryptocurrency, or you can buy the cryptocurrency using normal money also. Okay, Marshall Island, they introduced this SOV currency. SOV means sovereign currency. It is a type of cryptocurrency which is a legal tender in Marshall Island. It is near US. So they have two types of legal tender. One is SOV and one is US dollar. And the problem of this mining, they're using powerful computers. For this, GPUs are used, graphic processing unit. Because of this, there'll be a lot of e-wastes. Right. So this is one disadvantage of mining cryptocurrency. Okay. I'm teaching you a lot now, but I hope it is like you're able to understand all of them. All this is very important. Like questions can come. I have seen in test series. I will discuss questions also after this. Okay. In this only there are 2 pages of the blue book, but there is still so much content which I have to teach you. Okay, bear with me, please. Money supply. What is this money supply? Total stock of money in circulation among the public at a particular point of time. It is called money supply. What does money supply do? It determines the price level and the interest rates which has to be given for loans and all that. Okay. Now RBI publishes 4 alternative measures of money supply: M1, M2, M3, M4. Under that, this money supply we're discussing, that is M3. Generally, we take M3 as money supply because it gives a overall perspective. M1 and M2 are known as narrow money. M3 and M4 are known as broad money. Okay. Now let's not remember this M1, M2, M3 like this. We'll make a table. Now I've written this M1, M2, M3, M4. First column is coin and currency with public. Okay. You just have to tick mark all of this in the first column. Okay. Then in second column is commercial banks. Commercial banks have 2 types of accounts: demand deposits and time deposits. What is the difference between demand deposit and time deposit? I'll tell you that. Time deposit means, or when you say deposit, no, it is the liability of the bank. That means banks are obligated to give you back that money. It is not their money, so it is a liability for the bank. So either time deposit, or you can say time liability. For example, fixed deposits. In this, banks are not legally required to pay the customers before the maturity. So till the fixed deposit cut tenure, they'll hold that money, whatever you have deposited. So it is less liquid. But they can give you that money before the expiration of that, before maturity, but they will impose some penalty. Okay, and public parks more money over here. Why? Because it gives higher interest rate. FD, you get higher interest rates than demand deposits, savings account. And what is demand deposits? Demand deposits, again, deposits means liabilities. What are the examples of demand deposits? Current account, saving account, demand draft, overdue balance in FD, and unclaimed deposits. Now, I think you know what is current account, savings account. Current account means it is used on a daily basis. Savings account means you just deposit the money there and use it whenever you want. Demand draft, I told you that DD Vajiram ka example. Then overdue balance in FD. Let's say your FD got matured, okay, and you didn't withdraw all the FD amount. So there is some amount left in the bank. So that becomes a deposit, demand deposit, which you can demand later on. Then unclaimed deposits. Let's say if a person dies, he will nominate some person, no? That person will get it. Whatever unclaimed deposits are there. So this also, the nominee can demand it. So that's why it's demand deposit. Public parks less money here because you get less interest here. It is more liquid. Whenever you want, you can get that money. This is the difference between time deposits and demand deposits. Now another part I missed out. Why do people keep some cash in the hand? According to John Maynard Keynes, who is an economist, he wrote in his book General Theory of Employment. In this book, he told there are 3 reasons why people keep some cash in their hand and not all the money in the bank account. First reason is transaction motive. That is acts as a medium of exchange. If you want to buy something, money acts as a medium of exchange. It's a primary function of wealth. So that's why that is one of the reasons. Second reason is precautionary motive. For example, sudden unforeseen expenditure comes up. Let's say some medical emergency, or let's say you want to go to a holiday trip. So this is the precautionary motive. Then speculative motive. Speculative motive means to make best investment which arises later. You keep some money in your hand, right? And let's say you observe a stock market, or let's say you see gold ka price. If the gold ka price decreases by 5%, you will use your money to buy that gold. So this is one more example of speculative motive. So these are the 3 reasons why people keep money in their hands. Okay. Now I was discussing money supply, no? Commercial bank has 2 types of accounts: demand deposits and time deposits. And similarly, post office bank also has demand deposits and time deposits. Okay. Now after we make this table, another column is for liquidity. Liquidity means how liquid is the money, how easily you can use that money. Okay, and quantity means how much quantity is there in the supply in the economy. Now M1, for M1 you take this second row, that's all. For M2 you take this, and you take the post office demand deposit. M3 you take this, and take this. M4 take all of them. Now we'll see what is M1. Let's say coin and currency with public. There is some 10 rupees. 10 rupees coin worth of money is there with the public in the form of coin and currency. In commercial banks, let's say demand deposits, again 10 rupees. So what is the total amount? 20 rupees. Okay, but here since it is in the demand deposit and coin and currency, which is anyway public is holding it, so it is extremely liquid. So I'll give you 4 stars for this. M1, it is extremely liquid, but quantity is less. People will prefer to keep less money in the hand and as well as in the demand deposits because it gives lesser interest. So quantity is lesser. Now M2, let's say 10 rupees they will park here, they'll hold as coin and currency. Then demand deposits, okay, and then demand deposits of post office bank. Again demand deposit, no, that's why interest is less. So again they will put 10 rupees here. So what is the quantity here? 10 plus 10 plus 10, 30 rupees. Liquidity, since it more accounts are there, it is less liquid. Post office bank, no, I think they will have some restrictions on how much you can withdraw and all that. It is for small amounts. These post office banks is for maybe rural villages. So liquidity is less. Then M3 में coin and currency public 10 rupees, commercial bank demand deposits 10 rupees, and time deposits. Here in this case, time deposits is involved. When you include time deposits, it will be harder to withdraw this money because there is a maturity period which banks are not allowed to give you that money, so it becomes difficult. So that's why it is less liquid. But the amount, since it is giving more interest rate, people park 30 rupees here. So what is the total amount? 30, 10 and 10, so 50 rupees. Next, M4, coin and currency. You have to just tick mark everything here. So 10 rupees here, 10 rupees here, 30 rupees here because more interest, 10 rupees here, 10 rupees here. Let's say he just puts 10 rupees, or maybe he can put 30 rupees also here. But usually people prefer to put more money in commercial banks than post office banks. That's why I wrote 10 rupees here. So what is the total? 70 rupees. So you can see 10 rupees, 30 rupees, 50 rupees, 70 rupees. Quantity is increasing. From M1 to M4, the quantity of money increases, whereas the liquidity decreases. Okay, this table you have to remember. You can just remember the columns, and you can remember this blue color highlighted what I did. You have to put into there. Remaining all, you have to just put a correct mark. Okay, think of this like this. You have to tick mark all of this. Sorry, not tick mark. X mark all of this, except these two boxes. Here you have to tick mark. Same thing. This is that square. Yeah. This table actually helps a lot. You can just make this table very fast. In less than 30 seconds you can make this table, and or depending on the question you can answer it. वही लिखा है M1 M2 M3 M4. ठीक है. Then liquidity increase from M1 to M4 we saw here. M1 to M4 it is liquidity decreases, not increases, decreases. Now what is reserve money? Reserve money is M0. It is not written here. Okay. Currency held by public. What is the reserve money? Currency held by public, by banks, and deposits of banks with RBI. For example, I think this you understood, no? Currency held by public, currency held by banks. This is all self-explanatory, but what is this deposits of banks with RBI? For example, in PM Garib Kalyan Yojana, government told whatever black money is there with the people, they can come and deposit it with RBI. Like 25% of the money of that person's black money can be deposited here. Okay, this will help him avoid jail and all that. That is what the government told. Like if you have black money, come and deposit it. So all these deposits are there with RBI. So this is public deposits. Then CRR is bank deposits. Like CRR means cash reserve ratio. Like banks are mandated to reserve certain part of their assets. Assets are which are loans, right? With the money which people have deposited. Some part of it has to be deposited with the RBI. That is CRR. Yeah, so this is the sum of all this: currency held by public, currency held by bank, and deposits of bank with RBI. All this constitutes reserve money. Okay, it is the total liability of the RBI. RBI has to give this money. It has obligation to give away this money. Reserve money is also called as high-powered money, or monetary base, or base money, or central bank money, or M0. So it is a liability on the RBI. RBI may there is issue department, okay, who will issue the coins and currencies and all that. So it is a liability on them. Now, if RBI wants to print more currency, let's say, what they have to do to print more currency? Simply they can't print more currency in an economy. That will lead to inflation. So they have to print it according to this weighing scale, you can say. On one hand there is assets, and on the other hand there is liabilities. This assets and liability should match. Okay, depending on this only they can print more currency. Let's say assets. For example, RBI has to keep some assets like rupee coins. gold coins, gold bullion. Bullion means that bar you get, no? Gold bar. That is called gold bullion. So a minimum amount has to be kept. Like gold coins has minimum 200 crores you have to keep. Bullions minimum 115 crores you have to keep. Okay, and then assets can also include foreign securities, like World Bank and all that. They can issue securities. So RBI can buy that from IMF, World Bank, and all that, or from other countries as well. Then government security. Government borrows money from RBI. Right. This is government. This is RBI. Government borrows the money from RBI and gives government security in exchange. So this is an asset for RBI, government security. Because later on government will pay back this money with some interest. Okay, this is one asset. And liability side, we saw no high powered money. Currency with public, currency with other banks, and deposits in RBI. All these are liabilities. So this assets must match with liabilities. Then only RBI is empowered to print more money into the economy. For example, let's say it is matching right now. Okay, it is matching right now. And RBI wants to print more money. To print more money, RBI has to put more assets. So this will become heavier. Since it becomes more assets, they have more. They can print more money now and give it to the public or give it to the banks or deposit in the, or banks can deposit in the RBI. Okay, I hope you're understanding this. Then money supply. When does money supply increase? When the money multiplier increases. What is money multiplier? I'll come to that. For now, just see this. When RBI assets increase, I told you, when asset side increases, RBI gets the eligibility to print more money. So when RBI asset increases, more money supply will increase. And when there is loan demand, increase in loan demand, so people will take more money and more money supply will happen in the economy. When there is banking penetration, means more people are using bank accounts, even the rural villages. Then RBI adopts expansionary monetary policy. Expansionary monetary policy means reducing the repo rate, interest rates generally. So if you're reducing interest rates, then cheap loans will be given out. So money supply will increase at that point of time. I'll explain all this expansionary policy later on. Okay. Now money multiplier, I told you. What is this money multiplier? It is nothing but M3 divided by M0. Okay, money supply, which we saw here, M3, and monetary base, which is nothing but high powered money. Divide that, you will get money multiplier. Now I'll just give this example. Let's say M0 is 100. Okay, it is deposited in the bank by some people, some guy. So now the entire economy, there is 100 rupees, let's say, and this is given to bank 1. That person deposits this 100 rupees in bank 1, let's say, and there is a reserve ratio of 10%. So this 100 rupees ka 10% is 10, no? So 10 rupees, the bank 1 will keep it as reserve, and remaining 90 rupees will be given out as loan. Okay, now someone will take this 90 rupees loan, okay, and will let's say deposit it in another bank account 2. Now again, how much is the reserve ratio? 10%, no? 10% of 90 is 9. So 90 minus 9 is 81. So 81 rupees is given out as loan. Similarly, another borrower takes this 81 rupees, deposits in bank 3. Okay, and that bank 3 has a reserve ratio of 10% again. So all this reserve ratio is set by RBI. So for every bank it is same. So 10% of 81 is 8.1. 81 minus 8.1 is 72.9. So like this, it keeps on happening, right? In a zigzag fashion. So what is happening here? This indicates the banking habit of people has increased. So since the banking habit has increased, there is more creation of money here. You can see here 100 rupees was initially there, then 90 rupees was given as loan, then 81 rupees, then 72 rupees, 72.9. So all this if you add now, 100 plus 90 plus 81, so on up to infinity, let's say. It won't be infinity, but let's say it's a very small amount. So if you add this, you're going to get 1000 rupees. So what this is doing is, because of the banking habit of the people, this 100 rupees became 1000 rupees at one particular point of time. So that is the meaning of M3. What is M3? Money supply. Total money supply, because there was deposition of 100 rupees, is 1000 rupees now. So how much it has multiplied? It has multiplied 10 times, right? Why it has multiplied 10 times? Because the reserve ratio is 10%. So what we can conclude is, money multiplier is inversely proportional to reserve ratio. 10% means how much? 10 by 100, which is 0.1. So 1 by 0.1 is 10. So money has multiplied by 10 times, we can say 10x. You can see from 100 rupees to 1000 rupees it became. Now I'll tell you one CSAT here. How do we count this? 100 plus 90 plus 81 up to, let's say, infinity. This is a geometric progression. For this, there is a formula for getting the sum of all this. It is a by 1 minus r. What is a? 100. A is the first term. Okay, 1 minus r is the ratio between the second term and first term. That is here in this case it is 90 by 100. So how much is it? 0.9. So that is the value of r. This r will remain same for all. You can, if you do third term by second term also, you get 0.9. If you do fourth term by third term also, you get 0.9. So it's like that. It's a common ratio difference. So if you do this, what you will get? 100 by 0.1, which is 1000. So this is the sum of all of them, which is 1000. This is a CSAT part, which I'm just telling you here. Okay, I was telling this, no, money multiplier is inversely proportional to reserve ratio. So we see that 10x increase. The reserve ratio determines the money multiplier. So this means money has multiplied 10 times of the initial deposit. Initial deposit was 100. It has become 1000 now. This is only possible because of the banking habit of the people. Remember, people have borrowed it, deposited, borrowed it, deposited. Because of this thing only, it has increased. But in real life, people will not deposit like this, right? Banking habit is less. People will hold money in their hand. So what happened is, in 1960, let's say, this money multiplier is supposed to be 10x, but it turned out to be only 2x. Then in 1990, because of the digital schemes and more, not digital schemes, more banks were being opened, and more rural people started opening bank accounts. More banking habits started happening. So it became 3x. And now it became 5x at the present time. So all this depends on the people banking habit. It's an important thing. I will discuss in the MCQ about, I think one question is being asked regarding this. Okay, I hope you understood this money multiplier concept. It is inversely proportional to reserve ratio. Okay, apart from this, there is currency deposit ratio and reserve deposit ratio. Let's see, what is this? Currency deposit ratio. The name itself tells currency deposit. It is the ratio of money held by public in currency. How much money the public is holding in the form of cash, right, to the ratio of how much they hold in the bank deposits. Whatever deposit they have deposited in the bank, that upon whatever currency they are holding with them. This is currency deposit ratio. Now, is high CDR a good thing or a bad thing? High CDR means what? If the CDR is high, means they're holding more cash with their hand. So this is not creating any value in the economy. Like if it was there in the deposit, the bank would have lent it to some industrialist, and he could make some employment opportunities to would create growth and all that. So if you had deposited, it would create some growth, but here they're holding in hand, so it is of no use. So high CDR is a bad thing for an economy. It has to be in some minimum amount, but not too much. Then reserve deposit ratio. It is a ratio of reserves of a bank to the deposits of public in a bank. This is with respect to banks reserve and currency deposits with respect to people. Here it is a ratio of the reserves of bank, let's say CRR, to the deposits of public, whatever public deposits are there. Okay, this is RDR. Now if RDR is more, that means whatever deposits the public has made in the bank, let's say all of them, let's say there's 100, CRR is 100%, then bank has no money left to loan, zero money for loaning, so it creates no value in the economy. Everything is being kept in the reserve ratio. So this also is too much of this is a bad thing. It has to be kept in optimum levels. All this is decided by RBI. Now again, I told you money multiplier is, I already told you this, if the banking habit of people increases, money multiplier increases. Okay, I hope you understood this crystal clear. Okay, if you have any doubt, tell me. Now this primary reasons I already told you why people hold money in cash. Transactive demand, speculative demand, and precautionary demand. I already told you this according to John Maynard Keynes. Here I told you this one. Okay, this also I told you. Legal tender, what is it? Then after demonetization, all this, it is not a legal tender anymore. This white label and brown label ATM, what is this? Nothing. It is nothing but white label ATM means it is owned and operated by non-bank entities. They are not bank, but they are authorized by RBI. Let's say you and me. Okay, we can own and operate a ATM, but we should be authorized by RBI. Okay, and this has no brand. White label ATMs have no brand. What is the purpose? To provide ATM service to unbanked areas. Okay, example is Tata IndiCash. This is white label ATMs. Brown label ATMs means it is owned by third party but operated by a specific bank. It has a brand to it. For example, HDFC ATM Bank ATM managed by third party. Like HDFC is going to transfer the operation to a third party. Not operation. Like for example, HDFC will provide cash for the ATMs. They will comply with the RBI regulations. Right? They will handle transactions and customer support. All this HDFC will do. But what will the third party do? Third party, they will install the machines, and they will maintain the machines as well, whatever service they have to do for that machine, and they will also ensure that infrastructure is operational. Okay, this is an example of brown label ATM. It has a branding of HDFC, but installing, maintenance and all that is done by third party. What is the purpose of this brown label? To expand their ATM network without owning the infrastructure. Infrastructure is owned by third party. Okay. Nice. We finished it. Now this was just 2 pages, but I extended so much. Like all this is very important, so I didn't want you to miss anything. Now we will do MCQs. Here. Okay. Tell me this. Which one of the following statements correctly describes the meaning of legal tender? What did I tell legal tender as? It has to be fiat money and it has to be like the other person cannot refuse to accept it. So tell me, pause the video and guess the option. The correct answer is option D. The money which the creditor is under the compulsion is to accept the settlement of his claim. In other words, the other party cannot refuse to accept it. That is the meaning of this second statement. Second question. Consider the following statements in India. Minimum denomination coin acceptable for transaction of 50 paise. Coin below 50 paise is not a legal tender for payment. Which of the following is correct? Pause the video and try to answer. This one, both are right. This minimum denomination of coin acceptable for transactions 50 paise according to the Coinage Act. And coin below 50 paise is not a legal tender for payment because after 2011 they had denotified it. That 25 paise and all you cannot use for payment anymore. So since they denotified it, it is no longer a legal tender. Okay. See, all this we didn't study, but it has come in the exam, and this is a very old question. This is the 2011 question asked in CDS. Maybe in that point of time they have denotified it, so you should be knowing what is legal tender and fiat money. Okay. This question is just to test whether you know the meaning of legal tender or fiat money. Then consider the following statements. NPCI helps in promoting financial inclusion in the country. NPCI has launched RuPay as a card payment scheme. Which of the following is correct? Pause the video. Correct option is both. NPCI is for promoting financial inclusion, and it has a lot of products, and RuPay is one of them. Second question, with reference to digital payments, consider the following statements. Beam app allows users to transfer money to anyone with UPI enabled bank account. While the chip pin debit card has 4 factors of authentication, Beam app has only 2 factors of authentication. Which of the following is correct? Now we didn't study this, right? What is this? 4-factor of authentication, 2-factor of authentication. We didn't study all this. So these type of questions can come in the prelims. You should be ready to skip these questions or take risk. Ideally, these kind of questions you should skip them because nobody will know this. Okay, Beam app, first option is Beam app allows the user to transfer money to anyone with a UPI enabled bank account. This is correct. This is a general statement. Everyone will know this. Second option, 4 factors and 2 factors. This is wrong. It is 2 factors here and it is 3 factors here. What is this authentication? Like, for example, if you're doing an UPI transaction, first of all you will have to use your fingerprint to open the app. Okay, that is first factor of authentication. Next, after that, when you make a transaction, you need to enter the that whatever code is there, 6-digit code. That code you'll enter. That is another factor of authentication. Less so like that, whenever you're using this chip debit card, it will have 2-factor of authentication. Whereas Beam app, this app has only 3-factor of authentication. I think apart from this, they will verify your bank account and all that when you're first time using it. So the 3-factor of authentication. Debit card I think only just you have to swipe it. Okay, that is 1 factor, and you have to enter the pin. So it's 2 factors. It's just ideal to skip this question if it comes in exam. But now that you know some new information, just keep it in mind. Now, which of the following was the chairman to the committee on deepening digital payments appointed by RBI? Answer is Nandan Nilekani. This is not given in the blue book, but this person, he is associated with Infosys chairman, I think. Yeah, so he gave a proposal, like he was included in the committee for deepening digital payments. We didn't study this, but through this MCQ you know this knowledge. Which of the following statements about Bitcoin is correct? It is a decentralized virtual currency. It is generated through complex computer software systems. RBI of India recognized it as a legal tender in January 2016. Pause and try to answer. Okay. This is not a legal tender, so third option is wrong. It is generated through complex computer systems. Yes. It is a decentralized virtual currency. Yes, because it uses blockchain. Okay. Then regarding blockchain technology, consider the following. It is a public ledger that everyone can inspect, but no single user controls. It is the structure and the design of blockchain are such that all data in it are about cryptocurrency only. Applications that depend on the basic features of blockchain can be developed without anybody's permission. Pause and answer. Okay, first option, it is a public ledger where no single user controls. It's a correct option. Then second option, for only cryptocurrency, that is wrong. It can be used for other applications as well. Then applications that depend on the basic features of blockchain can be developed without anyone's permission. Correct. It is just a technology. Anybody can use it. It is not mandated that government only should be using this. Right? It's an innovation like AI. Blockchain is another technology, so anybody can use it. Then which of the following is not included in assets of the Commercial Bank of India? Assets means what? It means it's like investment for them, or it is their property. Which of them is their property of the banks? You have to tell not. Okay, it will not. I forgot to tell this. Answer is deposits, because deposits are liabilities. They are obligated to give this money back to the customer when he asks for it. So it is liability. All these advances, investments, money at call and short notice, all these are assets for the bank. Okay, what is this advances? Advances is the loans given by banks for, let's say, for credit card or for short term, any advances given, any loans given by banks. Investment is whatever investments they make in government securities and all that. Then money at call and short notice, these are the short term loans which are given by banks. Money at call and short notice, and they have to be repaid immediately to the banks with interest. So these are all assets of the bank. Next question, if you withdraw 1 lakh rupees in cash from your demand deposit account at your bank, the immediate effect on the fiat money supply in the economy will be? What is the answer? Now here initial amount is 1 lakh, no? So we saw in that money supply example, 100 rupees was deposited and the borrower took it, put it in bank 1, okay, and then another borrower took it, put it in bank 2, like that kept happening, no? Here, if the borrower takes that one, let's say it is 1 lakh, if he takes 1 lakh rupees from the demand deposit account, they're asking what is the immediate effect. Like at this point of time, they're asking, let's say he withdraws 1 lakh over here, okay, and he doesn't deposit to bank 2. They're asking for this immediate effect. If they're asking the overall long-term effect, then you have to add all of them. But since they're asking immediate effect, it won't increase the money supply here. It will be just 1 lakh. You have to not add all of them. You have to just see only this 1 lakh, because they're asking at this point of time. So it will remain same to leave it unchanged. The money supply in the economy will remain unchanged. Okay, if you are not understanding this, tell me again. I'll explain it in more elaborate manner. Then money multiplier in an economy increases with which one of the following? I think this one you already know. It is increasing the banking habit. I told you, no? Question will come like this. Okay, that's all. So we have completed, including the MCQs of all the for the money and banking chapter.